Okay, in this video I'm going to give you an example of what happens when a stock moves up and down. In our case, we're studying the Qs, the ETF. And what happens to the option that you've purchased when the underlying stock, in this case ETF, moves up and down at different price points. Now, if we take the Qs, and you can see that we have, remember, we have our call options and we have our put options. One of the nice things about the Thinkorswim platform from TD AmeriTrade is the fact that it gives you lots of information in one simple to read screen. And we can change our layout. The current layout that I have is the last trade, the net change for the day, in the bid and asks on each of the calls and the puts. If I wanted to, I could change that, and you could do theoretical price and the current market, volume and open interest. You could do probabilities of expiring and their delta. You can do position, intrinsic and extrinsic value, and you can also do the delta, gamma, theta, and Vega, which are the Greeks that we haven't talked about yet, but we will be getting into it in future videos. Let's take a quick look at position, intrinsic, and extrinsic. Now, if we had a position in this ETF, our position would show up under the position column. In addition, we have other information that we didn't have before. We have the extrinsic value, we have the intrinsic value, and we still have the bid and ask price. Now, as you can see, the deeper we go in the money, right now the Qs are trading at 57. So the at the money call and puts are the 57 strike prices. As we go deeper into the money, you can see the intrinsic value increases as we get deeper into the money. The extrinsic value, or another word for that is the time value of that option, decreases as we get deeper into the money. That's because there's more time value placed on at the money options or out of the money options. Actually, the most time value is given to the at the money options. That's why you see, in this case, the Qs have the 57 strike price Q calls have an extrinsic value or time value of about 72 cents. The extrinsic value of the 57 strike put has 82 cents in it. But as you go deeper out of the money and deeper in the money, you can see that changes dramatically. The farther you go out of the money, the less extrinsic value it has. And the deeper you go in the money, the less intrinsic value it has as well. That's because an option is comprised of both intrinsic and extrinsic value. As you get deeper into the money, in this case we're looking at the puts over here. Let's take the 68 put. It's currently trading between a bid of 11 and an asking price of 11.15. It has an intrinsic value of $10.93, of which, in addition, it has an extrinsic value of about 14.5 cents. Now, there's also something else that you need to consider when choosing an option. And we're going to be talking about in the next series of videos of how to select an option to trade. In most cases, when you're buying an option, you want to buy real value and not time value. When you're buying an option, you're going long that option. If you're selling an option, you want to sell extrinsic value. You want to sell time value. Now, because these options only have about 7 days left to trade, you can see that the December 11, 58 strike price has a very small extrinsic value. There's very little time value left in those options. The market is pricing these at 35 cents. The 59 strike price is only priced at 12 cents. In other words, they're determining based on probabilities of whether or not the Qs would actually rise above the 59 strike price or the 58 strike price in order to make a profit from the purchase of these calls. Now, when you're purchasing a call option, a single call option, it gives you the right to buy that stock at that strike price, but an equivalent of 100 shares. So for each call option is equivalent to purchasing or having the right to purchase 100 shares of stock. And when you're actually but the amount of the change of the option depends on what's called the delta. The delta will determine the actual price change. Even though you have the right to purchase 100 shares of stock, at expiration, that will become either intrinsic or extrinsic value. Until that time, the delta will determine actually how much that option will move in price relationship to its underlying instrument, in this case the Qs. So if we take a look at the, let's take a look at the Greeks. We'll change our layout to delta, gamma, theta, and vega. And you'll see that the delta for an at-the-money option at the 58 strike price is 0.30. That 0.30 means that for every dollar that the Qs rise, this option will rise 30 cents. So you can determine that if the Qs rise to the strike price of 58, it will the price of these options will rise to approximately 65 cents, rising 30 cents based on the delta for each option that you purchased. So a single option will rise by 30 cents. If we rise to 58 today, then that option will be priced at approximately 65 cents. These delta numbers will change on a daily basis. It determines the amount that the stock will move based on its current strike price. So, for example, if we go down to the 50 strike price, it's the option there is currently priced at 703 bid, 709 asking, and and the delta is at 0.94. So if the Qs rise by $1, this option price will rise by 94 cents. And that's what the delta does. It helps you determine how much of an increase in the option price will be a gain for you if the underlying ETF should rise by $1.